Shraddha is a young consultant who has an eye for sparkle. It's where she spends most of her money.
I love gold quite a lot. Every time I have some money saved in my account, I go and I buy myself some gold jewelry. Well, it's totally bleeding my bank account, but it's alright.
So the trinkets make Shraddha happy. But what would make her positively ecstatic was if her gold purchase were to begin to earn money for her.
Gold is a time-tested safe asset class. It's got a unique internal intrinsic property of being able to hold its own value. That's why it's considered as an inflation hedge.
An investor who is just looking at gold for investment purpose, he should look at least a period of 1 year, 2 years. And in that, whatever be the price fluctuation, like suppose the US market is recovering or the dollar is appreciating again, then also over a period of 1 year, actually the investor is not going to lose money.
So you won't lose any money by investing in gold, but will you gain some? Gold is currently trading at 16,600 rupees per 10 grams, and experts say it's going to go up even further. Experts say the spike in gold prices are driven by the sentiment in the stock market and the strength of the dollar. But that's in the short term. In the long term, however, the price of gold is based on demand, which is not about to run out in our country.
Demand अच्छी रहेगी.
The demand will increase in some time right now.
भाव ऊपर जाएगा.
And now that we've established that, let's get down to business. Now there are 4 ways you can invest in gold. Firstly, you could buy jewelry, but you would lose out on making charges and service tax when you try to sell it, and that's almost 10%. It might wipe out your entire gain. Secondly, you could buy gold coins or bars, but the safety of your purchase would be an issue. Hiring a bank locker would be expensive, and that again would eat out of your return. We recommend you buy a demat gold asset, like a gold ETF or a demat certificate from the commodities market. A gold demat account on the National Spot Exchange will allow you to trade gold on India's commodities markets without having to physically buy the metal.
National Spot Exchange, which provides a platform for buying and selling of gold in the form of demat delivery, demat transfers. What it means is that you can buy gold just like you are buying shares. You can hold gold in demat account.
You won't need to worry about the physical gold being stolen or about being duped by a goldsmith selling fake or sub-quality metal. There is a catch though. The minimum value you can hold on the commodities market is 8 grams of gold. Your other option is a gold ETF or an exchange-traded fund. It functions just like a mutual fund. The money you invest is used to buy gold bullion on the London bullion market, and the dip and rise in global gold prices is reflected in the value of your holding. Now there are 5 Indian fund houses which have gold ETFs in the market, and how do you choose which is the best one for you?
The only differentiator could be how much cash you have over time, how efficiently you are able to run it, and what is your expense ratio, what is the cost incurred in running that ETF. So on both these count, I think Benchmark has been able to deliver little superior return, but in normal conditions, but the difference is very nominal. The difference between the worst and the best performing gold ETF over the past 6 months or 1 year is something which is not meaningful. But as of now, Benchmark ETF looks better.
So there you have it. Before you pull out your checkbooks, here are some tips to get you started. Don't invest any more than 10% of your total portfolio in gold. Just like an SIP, make sure your gold investment is systematic. Buy small amounts of gold on a regular basis to average out the cyclical market. As a retail investor, don't let the daily price fluctuations make you nervous. Just like equities, gold should be a long-term asset.